earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is it's moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Stocks wilting and off their highs at the moment as the Federal Reserve breaks out its hatchet and chops rates for the first time this year. I'm Liz Klayman. This is the Klayman Countdown. Fed Chair Jerome Powell still speaking to the press. Let's go back to the news conference.
Independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Neil.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college, and yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things, but yeah, it's probably a factor. Hard to say how big it is.
Andrew.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than than we thought. But the evidence is, it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Katerina. Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on, one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of, the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times, but from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Archie.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right? Well,
that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So. We watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs, so of today's decision.
Nicole.
Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to 0, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices, so that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape. in the aggregate, and I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities, and I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets, and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of, running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates.
Thank you.
Thanks very much.
Federal Reserve Chair Jerome Powell playing kind of like a soccer goalie here, fielding all kinds of incoming questions, not just about what is now the first rate cut this year, but inflation, which he said could be persistent, particularly rising goods prices, and that's a risk. That's what he said. Tariffs, which he said could soon seep to consumers into their costs. He talked about the weakening jobs picture and the new kid on the block at the Federal Reserve, Stephen Myron, President Trump's chair of the Council of Economic Advisors, who now joined the Fed for his first meeting and was the sole dissenter to the 25 basis point cut to interest rates. He wanted more. He wanted 50 basis points. So let's get to market reaction. It's really been jagged here. Before the 2 p.m. announcement, we can show you the intradays here. The Dow was up 376 points. It then spiked as high as 504 points. Then about 25 minutes into the 2:30 p.m. news conference, it dove into the red very briefly, and right now we've got it back up about 220 points. Flip it over to the S&P. The S&P had been in the green, up about 17 points. It then dove 55 points. Right now, still in the red, but just barely here, down 4 points. Looks like it's trying to get back to the flat line here. And if we look at the S&P, we see that. Let's look at the NASDAQ. NASDAQ has been struggling a bit more. I believe at the low of the session right there, it had fallen about 214 points. That may be an old number because we've been rushing around looking at this. Low of 275. NASDAQ fallen as low as 275. Right now, it's down 48. Not too bad here. The Treasury world. This is interesting, and we're going to start showing you the 1 month. We're going to show you sort of the shortest end of the curve. Because for those of you who don't know, the Fed funds rate is actually the shortest rate, right? It's the rate that the Fed charges banks to park their money at the Federal Reserve. So the 1 and 3 month would probably be closest in reaction here. You see what they're doing? At least the 1 month was falling. The 3 month up just about a half a basis point here to 3.973%. Earlier this year, it was at 4.87. So these rates have come down. You can see year to date. And then let's look at the 10-year here, unless you got the 6 month. 10-year. OK, let's do the 10-year. It's gaining about 2.7 basis points, which indicates that on the longer end, rates are pretty much where they were, still above 4%, 4.05. And then the 2-year, 3.53, 6% up 3.3 basis points. So the VIX has been moving up and down here, but in no gigantic terms, right? You have the VIX at the moment down just about 6.7%. That's the biggest move, and that means fear is coming out of the markets. Look at gold. Gold, which has been on an absolute tear this year. Coming into the session, it was up about 40% year to date. Right now, we've got it down about $27 to $3,697 per troy ounce. So just a bit paring back. Gold is often sort of that flight to quality trade. Now, the U.S. greenback coming into the session, the U.S. dollar was at a 7-month low against major currencies. Rate cuts are dollar negative usually. Right now, it is a mixed picture, but keep your eye on the euro-U.S. dollar. Right now, the euro is pulling back from what was a 4-year high against the dollar. Right now, we see just a little bit of retracement here. The euro is at 118 per dollar. It was at 119 coming into the session. Overarching theme from Jay Powell was that the Federal Reserve finds itself in quite a weird position of facing weakening labor numbers and inflation that's still sort of the house guest that just won't leave. Here's how he described coming to today's cut.
I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests.
Joining us now, former National Economic Council Director and IBM Vice Chair Gary Cohn, to break this all apart and then try and put it back together again. We just got this breaking news. JP Morgan has just lowered its prime lending rate to 7.25%. That's usually what happens when there is a Fed rate cut, but rates are coming down. That's what President Trump has wanted.
Well, the front end of the curve is coming down. You just pointed out that the Fed funds rate is the overnight rate for banks. And in fact, unfortunately, it affects consumers in the wrong way. So if you have money left at the bank and you're earning overnight deposit rates, you end up getting less interest on your money. If you're borrowing money from the bank, those rates did not come down today. So if you're borrowing money for your car, you're borrowing money on your credit cards, you're borrowing money to buy a house, those rates have not come down yet. They have been drifting a little bit lower, but remember, Fed funds is the front end, and what you showed is the curve is actually steepening, meaning long-dated rates are going up today, they're not coming down. So this was a small, sort of maybe introductory or maybe the only move that the Fed's going to make here.
Well, that leads to the question of what jumps out at you most regarding what we finally saw from the so-called dot plot, which basically maps what each and every member of the Fed, all 19 members, think the Fed funds rate is going to be at the end of this year.
Look, I think this is the fascinating part of today. So you had one governor say they didn't want today's rate cut, even though they voted for it. You have 6 that say they want no more cuts this year. You have 9 that say 2 more cuts this year. And you have 1 that wants 5 more cuts this year. In 2 meetings, that's a lot of cuts.
And we think that is who?
Well, we can all speculate who we think it is. And maybe the newest member of the board.
The new kid on the block.
The new kid on the board definitely established himself. So if you take where we are today, Fed funds at 4.8%, 4.08%, we're showing a 3.6%, which is the 2 rate cuts. This is not a seismic shift in monetary policy or Fed policy. This is a gradual changing of policy. And I think the chairman tried to walk us through that. He's in a dilemma. I mean, he tried to describe his dilemma to us today. He says, look, I've got a dual mandate. I've got stable prices, which is 2% inflation, and I've got full employment. Those 2 things are at odds with each other right now. I've got inflation that's over 2%, which is my threshold level where I'm trying to shoot at, but I have employment that's not at a level I want. And I see the employment market deteriorating. So the numbers today haven't really shown up in the unemployment numbers because the denominator is changing. But when he looks at the monthly jobs coming into the system, he sees what we all see. We've gone from 150,000 new jobs a month to 25 or 30,000 jobs a month. So the chairman's trying to say, look, I see that the job creations aren't there. So I'm now weighing Do I fight inflation? Do I fight unemployment? If I fight one, I might be stimulating the other. And he's now into the point where he said, okay, he said, I'll take a risk management interest rate cut here to try and stimulate some more employment
And
growth.
he had telegraphed that a month ago at Jackson Hole at the big hoo-ha that they had with the central bankers. So when you look at what would happen when it comes to the markets, we are at or near record highs. By the way, the S&P has turned positive here, up 2 points. The NASDAQ is trying to get there. I think at the moment we got the NASDAQ. Let me just quickly check. But as we continue to watch this, the NASDAQ is now down just about 26 points. Dow still up about 245 points. I mean, what is the case, Gary, for another rate cut or two?
So look, today's move was not negative to risk assets. So this should not affect the way people are thinking of owning the U.S. markets, owning assets here in the United States.
Then why do you think Bitcoin is down more than $1,170? Risk asset.
I don't know. Look, gold's down, Bitcoin's down. These flight to quality assets, these flight to safety assets are definitely down. People are happy to buy risk assets. We didn't end up with a Fed that was in disarray today. I think that's another message that came out of here. You know, the chairman literally had almost uniform consensus for the vote today. He had one dissent. Going in, I think many of us thought there could have been dissents at both ends. There could have been dissent for someone that didn't want to raise rates, and there could have been 3 or 4 dissents for people that wanted to go higher than 25 basis points. When you look at what happened here, they had quite an orderly meeting. The Fed seems like it's in control. The chair is in control. And if you were buying these risk assets and there's an insurance policy, the gold or Bitcoin or things like that, you walk away from today going, the Fed seems to be working pretty orderly right now.
Well, let's put it this way. The last time around, there were 2 dissenters, Chris Waller and Michelle Bowman. This time around, just one. And it was neither those 2. It was Stephen Miron, the new kid on the block. And Jay Powell was asked about that in sort of a couched way. And here's what he said about Stephen Miron.
No one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then
I got to tell you, he's probably walking out of there like the cat that ate the canary, meaning Jay Powell. He got most of the team cohesive and together on this.
Yeah, that's a news flash out of here. One dissent. And as you point out, 2 dissents last time, Bowman and Waller. Bowman and Waller went for the 25 basis points. You had pretty unanimous group in there today. I think that's a really good moment for the chair, as you say.
Is this going to enrage President Trump, or what do you think he's thinking at this moment?
Well, look, we all know the president wants interest rates lower, and we know that he's looking at certain parts of the economic data. He's looking at the job creation side. Look, if you're looking at the job creation side only, and you're seeing 25, 30, 40,000 job creations in a month, you would want interest rates lower. If you're looking at the inflation side only, you would have a different opinion. The chair's trying to tell you, I've got a dual mandate. I'm trying to balance this. He really has 2 goals that are in opposition to each other, and that's where he is right now.
Well, yeah, exactly. If we can put up some of the markets, particularly the S&P, it is now down 1 point. So again, the market is trying to feel and field exactly what this all means. We've got some winners: Workday, Hologic, Fox Corporation, the parent of this company, PayPal. There's the S&P at the moment. Just let's call it flat, but slightly lower, which indicates, on these kind of days, we usually see a big jump or a big fall. At the moment, it's sort of like, oh, where are we going here? So best advice to investors, Gary?
Look, I think the Fed told you everything they've been telling you in the past, but it's more important. They're news dependent right now. They're not 100% sure which way the job market's going. The chair talked about he thinks the job market will be improving. So he's telling you that he believes the economic data going forward will be better for the job market. He also said, on his other side of the mandate, he thinks inflation is continuing to come down and they've got inflation under control. So if the job market improves and inflation comes down, The investors should understand that. That means that the Fed does not have to do a lot, even though the chairman admitted they've been in a highly restrictive policy. They'll probably work their way more back towards neutral. But remember, it was a very close call among the members, whether it was 2 cuts or 1 cut for the rest of the year. You know, I don't think it's baked in, it's 2. It could be 1. And I think the markets have to understand that the Fed is just as news dependent as every investor is today.
I think you're right. It's not a sure thing that we will see 2 rate cuts. Gary, great to have you. Thank you very much. You know, this meeting actually takes on added drama because the Fed just revealed the latest dot plot. That dot plot comes out once every quarter and anonymously charts each Fed member's year-end interest rate forecast. No one is better at connecting the dots of the dot plot. Fascinating that we only had 1 dissent and that, you know, we put all of these numbers into the cauldron and out comes the dot plot. You say what about it?
You know, what really is interesting is that we saw basically Chairman Powell corralled the cats. And I think the stronger than expected retail sales numbers actually moved the needle on no dissents from Governors Bowman or Governor Waller. So that only 1 dissent by Steve Moran, looking for more of a 0.5% cut. But this really is no sure thing on another 2 cuts. And the uncertainty, he really underscored that several times. The forecast still has a mild bout of stagflation in it. And that is what the Fed is trying to manage. He talked a lot about the labor market, but he also talked about how unusual this situation in the labor market is, where the break-evens on how many payrolls we need each month have really fallen down to levels that are within the margin of error of 0. That is a very different kind of labor market than we had in the past. That doesn't mean there isn't weakness. I have a lot of sympathy and empathy for how much underlying weakness there is in the labor market. Those who have a job are frozen in place. Those who want a job are frozen out. That is not a healthy labor market. A healthy labor market has a lot more churn. The problem is we just don't know how familiar we've gotten with inflation, and the embers of the pandemic inflation were still smoldering, and the way in which tariffs are coming out, they're coming out in phases. That means you'll have waves of increases in prices or more margin compression, and that uncertainty could more inflation expectations. And that's economist speak, but it really means there's a self-fulfilling prophecy risk out there that the inflation, by expecting inflation by both consumers and firms, it could become a self-fulfilling prophecy. And you cannot get full employment sustained if inflation stays out there, especially given the inequality that we're dealing with right now. That said, if you think inflation is going to go to a little above 3%, because of tariffs and then come off, why would you risk a recession for 3%? We're not talking about the 9% blistering inflation that we saw during the height of the pandemic.
Well, look, we should cycle through some of the important points that Jay Powell made when you talk about everything from inflation and the tariffs, which, you know, I think he was trying to thread a needle here, wasn't he, about the tariffs, where he said it's pretty obvious that we have not actually seen the tariff costs that importers are paying here in the United States spill over to the consumer, but that they actually could. That said, I like your comment about how you believe that Chair Powell was able to corral the cats, so to speak, meaning show more unity. Here's what he said about the Fed making this decision together today. Listen.
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to, to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change.
President Trump wants to reshape the Fed. I think it's pretty clear, correct? And therefore, with Stephen Miron aboard, Stephen Miron, the Council of Economic Advisors chair, who has taken a leave of absence while he replaces Adriana Kugler on the Fed, he was the one dissent. And it wasn't that he didn't want a 25 basis point cut or no cut at all. He wants 50 basis points. Do we need to see a 50 basis point cut right now?
I think that would be premature, just given, even though I'm very worried about the labor market, we just don't know. And we had the mother of all frontline running in terms of anticipation of tariffs. We have a lot of stuff that's on store shelves that was actually bought before tariffs went into effect. That helped to blunt the blow of tariffs. He also went out of his way to point out where tariffs were showing up in goods prices. Something else the Fed is struggling with is because of this inequality out there where the bottom 80% of Americans have basically stagnated, lost almost everything they've gained in wages and spent not anything above inflation because of that, where the top 20% are carrying the economy. That's not a great place to be, but it also is creating this underlying floor under service sector inflation that we've seen emerge out there. In the month, the retail sales numbers were stronger, and he talked about that, yet it had a decline after adjusting for inflation in grocery spending and an increase in restaurant spending. That really gets into the inequality and the role that affluent consumers are playing in holding up service sector inflation that's come up a bit after it had cooled. And that's something that is also worrisome, because that's something the Fed had basically assumed would be a major offset to any of the bump due to tariffs. He did stick to his quote that, the base case is that this will be not all at once, but a one-time kind of increase in price levels that's spaced out a bit because of the uneven rollout, and then it will taper off. That's what the Fed has forecast. And I think this is a very hard, he said, it's challenging when their dual mandate are going in two different directions.
Diane, thank you very much for kind of putting it all together for us as we continue to watch the markets. We appreciate you coming on here. And still the S&P 500 just slightly in the red, down about 2 points. So we're watching that mostly. It really reflects the broader market better than the Dow Jones Industrials, which right now is up about 263 points. We've got this Fox Business Alert. Need to get you some individual stock stories right now. Shares of online ticket marketplace StubHub down 5.6%. after making its public debut on the New York Stock Exchange. So first day of trade, the ticket event resale platform is lower. Okay, at the moment, it's at $22.19. It originally spiked, as you see, in the middle when it first came out, about 8% earlier in the session. Opened at 12:15 p.m. at $23.35 a share, compared to the offer price of $23.50, which values the company at $9.3 billion. StubHub's public debut did raise nearly $800 million. They've sold about 34 million shares. The long-awaited IPO of the secondary ticket site comes 6 months after it pulled the plug on listing plans due to President Donald Trump's tariff policies. Things calmed down. They went public. Not a great opening day, but listen, opening days have very little sort of weight when it comes to the long term. The robo-taxi race is heating up. Shares of ride-hailing giant Lyft are accelerating to a 3-year high, jumping 12.75%. The company announced it is partnering with Alphabet's Waymo for the first time ever to launch autonomous rides in Nashville next year. Rival rideshare company Uber is falling on the news by about 4.5%. It already does have an existing robotaxi partnership with Waymo in Phoenix, Austin, and Atlanta. According to Lyft, its fleet management company FlexDrive will provide the infrastructure, vehicle maintenance, and operations for Waymo's self-driving cars in Nashville. Let's look at Alphabet. It's down 0.5%. after closing at a $3 trillion valuation. Workday surging to the very top of the S&P and the NASDAQ. It's gaining 7.25% after activist investor Elliott Investment Management announced it's taken a $2 billion stake in the software company. Yesterday, Workday revealed it will buy back some $5 billion worth of its stock through fiscal year 2027. Workday is that human resources software maker. It's planning to boost its product offerings and operations to stay competitive with the growing demand for artificial intelligence. Elliott released a statement supporting Workday CEO and CFO, saying, quote, "The entire Workday team has made substantial progress in recent years, positioning Workday as a unique software franchise with industry-leading growth potential, best-in-class customer retention, and a proven management team." President Trump finally gets what he's been asking for from the Fed, although I bet he probably wanted it to be just a bit bigger. It comes as the commander-in-chief is far across the pond. He's not paying attention right now to what's going on at the Fed. He's making his second state visit to the United Kingdom. What we're going to do is take you live to Windsor Castle, where King Charles III is about to host a state dinner for the President and First Lady. That's straight ahead on the Clayman Countdown. Don't go away.
Fad diets, outrageous workouts. What haven't you tried? If weight loss isn't clicking, there may be a different way. Zepbound may help you go further in your weight loss journey. Zepbound helps adults with obesity lose weight and keep it off. People taking Zepbound lost up to 48 pounds. It works with your body, so you're not doing this alone. Dual activating Zepbound works differently. It activates the receptors of GLP-1 and GIP, two naturally occurring hormones.
Don't take if allergic to it, or if you or someone in your family had medullary thyroid cancer or multiple endocrine neoplasia syndrome type 2. Tell your doctor if you get a lump or swelling in your neck. Stop Zepbound and call your doctor if you have severe stomach pain or a serious allergic reaction. Severe side effects may include inflamed pancreas or gallbladder problems. Tell your doctor if you experience vision changes, depression, or suicidal thoughts before scheduled procedures with anesthesia. If you're nursing, pregnant, plan to be, or taking birth control pills. Taking Zepbound with a sulfonylurea or insulin may cause low blood sugar. Side effects include nausea, diarrhea, and vomiting, which can cause dehydration and worsen kidney problems.
If this is clicking for you, it may be time to take the next step in your weight loss journey. Click for more at Zepbound.com and ask your healthcare provider about Zepbound.
If you really want to gauge how an investment will perform under pressure, you test it. You stress it. You throw everything you have at it. So at Federated Hermes, we put our investments through a ruthless vetting process, gaming out every scenario we can imagine. Because we want to see how an investment performs before we invest in it. Federated Hermes, vetting for a volatile world.
You're a finance guy, right? How do I work less and get to Paris more?
I want to get my finances in order. They're a bit abstract.
Steve, you made it. This opening wouldn't have happened without you.
Very interesting collection.
The freedom to make all your clients' dreams a reality. The feeling is MassMutual.
This is the new Dell AI PC with Intel inside. A PC so ahead of its time, it actually helps you save time. Like literal hours. Because it does all your busy work for you. So you can get busy doing things you actually want to do. And who wouldn't want more time for that?
The Make America Healthy Again revolution, from the foods we eat to the medications we take, inside the movement that's reshaping it all, only on Fox Business.
Hi, Charles Payne here. If you're over 50, like me, retiring wealthy isn't just about saving more. It's about protecting what you've earned and making smarter decisions with the money already in your accounts. A recent survey showed that 70% of people over 50 are now considering delaying their retirement. But you don't have to be one of them. My newest book, Unbreakable Investor, will show you how you can begin boosting your returns in your 401k, your IRA, and brokerage accounts. Strategies that target double-digit returns, often in remarkably short periods of time. This retirement crisis is so dire that I'm offering you a free copy of my book. Imagine what it could feel like retiring on time, or maybe even a little early. Claim your free copy today.
Text the word RETIRE to 505-505 for your free copy of Charles Payne's new book, Unbreakable Investor. Text RETIRE to 505-505. Text RETIRE to 505-505 now.
From our homes to our businesses, staying safe online has never been more important. PCmatic protects against viruses, ransomware, and scams. And unlike the others, PCmatic is proudly made in America and trusted nationwide. Whether you're protecting your family photos, your company's data, or critical government systems, PCmatic has you covered. Simple and affordable. PCmatic, trusted to protect America's computers. Visit PCmatic.com today.
Breaking news, President Trump and the First Lady now attending a state dinner at Windsor Castle with King Charles III and Queen Camilla. It is a historic second state visit for the president to the United Kingdom. Prime Minister Keir Starmer and Lady Starmer will join the King and the President at dinner, and Prince William and Princess Catherine are there as well. Some of the biggest CEOs in Silicon Valley are among the 160 guests. NVIDIA CEO Jensen Huang, who, by the way, has been all over the map and is sort of this pawn between U.S. and China trade wars, because today, according to the Financial Times, yeah, the Chinese are saying that no Chinese company should be buying NVIDIA chips. I mean, really? And so you've got NVIDIA shares down about 2.5%. Apple CEO Tim Cook is there, Microsoft CEO Satya Nadella, OpenAI CEO Sam Altman, ARM CEO Rene Haas, and Salesforce CEO Mark Benioff all got the invite. Nice. Wall Street, represented by Citigroup CEO Jane Fraser, Bank of America CEO Brian Moynihan, BlackRock CEO Larry Fink, and Blackstone CEO Stephen Schwartzman. They're among those reportedly attending the lavish dinner. And guess what? Well, Steve Doocy didn't exactly get an invite in there. I hear you're going to crash it, but you're right there in London. Here in London. Just to let you know, we are seeing the Queen walking in with Melania, First Lady Melania Trump.